The title of this piece contains a promise, and before a single word of strategy is discussed, that promise needs to be examined with complete honesty, because the promise itself is the most important thing to understand about the stock market before anything else. Never lose again. It is a phrase designed to reach into the part of the brain that wants certainty, that is exhausted by risk, that has perhaps already experienced the particular pain of watching money disappear in a market that seemed to be going well and then suddenly wasn't. The desire to never lose again is one of the most human responses possible to financial loss, and it is also, without exception, a desire that the stock market cannot fulfill for any participant at any level of experience or sophistication. Not because the right strategy hasn't been found yet. Because the structure of financial markets makes permanent loss-free participation a mathematical impossibility, and any education about the stock market that begins from a different premise is not education, it is sales. That said, there is something real inside that promise, something worth pursuing even if the literal version of it is undeliverable. The real version sounds less exciting but matters more. The possibility of participating in the stock market in a way where losses are managed, controlled, understood, and ultimately smaller in their cumulative impact than the gains that compound alongside them over time. The possibility of building a relationship with risk that doesn't require certainty to function, because certainty is never available, but that produces consistent, reliable results over long periods precisely because it is built on an honest understanding of how markets actually work rather than how people wish they worked. That is achievable. It has been achieved repeatedly by people who came to the market with no particular advantage, except the willingness to understand what they were actually dealing with before committing capital to it. What follows is that understanding, built from the ground up, without the shortcuts that feel helpful in the short term and cost enormously in the long run. The stock market is not a place where value is transparently and efficiently reflected in prices at all times. That is the theoretical model, and it has enough truth in it to be useful as a framework, but the reality is far messier. Stock prices are determined by the collective behavior of millions of participants, individuals, institutions, algorithms, pension funds, hedge funds, retail investors, speculators, long-term holders, each of whom is operating with different information, different time horizons, different objectives, and different emotional states. The result is a price at any given moment that reflects not pure value, but a constantly shifting consensus about value, heavily influenced by sentiment, narrative, momentum, and the psychological dynamics of crowds. Understanding this is foundational because it means that the market will frequently do things that seem irrational from a pure valuation standpoint. Price good companies too low when fear is dominant, price mediocre companies too high when enthusiasm is running ahead of fundamentals. Sustain trends in both directions longer than any logical analysis would predict, and reverse without warning at moments when everything seemed to be going in one direction. The strategy that functions in this environment is not one that ignores these dynamics and focuses only on the underlying numbers. It is one that integrates both, understanding what a business is fundamentally worth as a starting point, and then understanding how the market is currently pricing that business relative to that worth, with full awareness that the gap between price and value can persist far longer than patience allows if the approach is not structured correctly. The core of what actually works in the stock market over long periods, and this is verifiable across decades of market history, across different countries and asset classes, across different economic cycles, is a framework built on three interconnected principles: buying quality at a reasonable price, managing risk through position sizing and diversification, and allowing time to do the work that neither analysis nor timing can do. These principles are not secrets. They are not proprietary. They are not the exclusive domain of professional investors with access to information that retail participants cannot reach. They are available to anyone, and the reason most people don't benefit from them is not that the principles are difficult to understand, but that they are psychologically difficult to implement and maintain through the conditions the market creates over time. Starting with quality, what does it actually mean to buy a quality business, And why does it matter more than almost any other single variable in long-term investing? A quality business has a set of characteristics that allow it to generate returns on the capital invested in it that exceed the cost of that capital, and to sustain that advantage over time in a way that compounds the underlying value of the business year after year. The specific metrics through which this shows up include consistently high returns on equity without excessive leverage, strong and growing free cash flow that is not entirely dependent on capital expenditure cycles, a business model that generates revenue in a recurring or predictable pattern rather than lumpy and uncertain cycles, and a competitive position that is genuinely difficult for new entrants or existing competitors to displace. These characteristics are not always present together, and when they are, the business is rarely cheap, because other market participants have also identified them, and the market tends to price quality at a premium. This is where the second part of the principle becomes critical. Reasonable price does not mean cheap price. It does not mean buying only businesses that trade at low multiples of earnings or book value, because businesses that trade at low multiples often do so for legitimate reasons: deteriorating competitive position, cyclical earnings that are currently inflated, structural challenges in the industry, management issues that the low multiple is correctly reflecting. Reasonable price means buying a business at a price where, given realistic assumptions about its future growth and the current level of interest rates, the expected return over a 5 to 10-year holding period is attractive relative to the alternatives. This calculation involves estimating future earnings or cash flows, applying a discount rate that reflects the risk and the opportunity cost of capital, and arriving at a range of intrinsic values within which the current price is reasonable, stretched, or deeply discounted. The estimate will be wrong. All estimates of future business performance are wrong to some degree. The point is not precision. It is building in enough margin of safety that even if the estimate is somewhat optimistic, the price paid still represents a reasonable entry point. Margin of safety is the concept that changes the relationship between analysis and outcome in the most practical way. When a business appears to be worth significantly more than its current price, when the analysis, even with conservative assumptions, points to a value well above what the market is currently offering, that gap between price and estimated value serves as a buffer against errors in the analysis, against unexpected deterioration in business performance, against the simple reality that forecasting the future is an inherently uncertain exercise. The wider the margin of safety, the larger the buffer, and the more room the investment has to be imperfect in its execution and still produce a satisfactory result. Buying at a price close to estimated fair value requires the analysis to be nearly perfect to produce a good return, because there is no buffer. Buying at a meaningful discount to estimated fair value means the analysis can be somewhat wrong and the investment still works. This asymmetry, protecting against downside through price discipline, while preserving the upside of quality business performance, is the structural foundation of investment returns that hold up over time. Risk management, through position sizing, is where many investors who understand the analytical side of this framework still go wrong, because position sizing feels like a secondary concern compared to the excitement of finding a great company at an attractive price. It is not secondary. It is primary, in the sense that it determines the survivability of the portfolio through the inevitable periods of being wrong. Even the most rigorous analytical process will produce investments that don't work out, businesses whose competitive position deteriorates in ways that weren't anticipated, industries disrupted by changes that weren't visible in the data, management decisions that destroy value that the analysis assumed would be created. Concentrating a large portion of the portfolio in any single investment, regardless of the conviction behind it, means that being wrong on that investment has a large and potentially unrecoverable impact on the total portfolio. Distributing the portfolio across a sufficient number of positions, not so many that each position is too small to matter when it works, but enough that no single failure is catastrophic, manages this risk without requiring any investment to be excluded on the grounds that it might fail. The typical framing of diversification in mainstream financial advice is too mechanical to be truly useful. Holding 30 stocks across different sectors, because a formula says diversification requires it, is not the same as holding 15 to 20 businesses that have been individually analyzed and selected based on quality and price criteria, where each position represents a meaningful allocation, but none represents a threat to the portfolio's survival if it goes wrong. The first approach diversifies away the possibility of concentrated gains along with the concentrated losses. The second approach maintains the potential for meaningful outperformance while limiting the damage from individual mistakes. The distinction matters enormously over a full market cycle, which is the only time horizon over which investment approaches can be honestly evaluated. The role of time in this framework is perhaps the most misunderstood element of all, because it cuts against the dominant culture of financial media, which is built almost entirely around short-term events, quarterly earnings, price targets, buy and sell recommendations that carry implicit time horizons of weeks or months, and the general narrative that participation in the market requires constant attention and frequent action. The reality is the opposite. The value that a quality business generates compounds over time in a way that is entirely invisible in the short term and becomes overwhelming in the long term. A business that grows its earnings at 12% annually doubles its earnings roughly every 6 years. Over 20 years, it has grown them by more than 9 times. An investor who bought that business at a reasonable price 20 years ago and held without interference has participated in that compounding in direct proportion to their ownership stake. An investor who bought the same business and sold it 18 months later because the price hadn't moved much, or because the market fell and the position was uncomfortable, participated in almost none of that value creation. The math of compounding is straightforward, but its psychological implications are not. Compounding works silently over periods that feel long in human terms, and its results are almost invisible for the first several years of any given investment. The account doesn't look dramatically different after year 2 or year 3. It starts to look materially different after year 7 or 8, and dramatically different after year 15 or 20. But the culture of investing and the emotional experience of watching prices move daily, of reading quarterly updates, of constantly being presented with new ideas and new opportunities, creates a pull toward action that works directly against the patient accumulation of compounding returns. Every time a position is sold before its natural conclusion, the compounding chain is broken and reset. Every time new capital is deployed into a mediocre opportunity because the portfolio feels underinvested, the overall quality of the portfolio declines slightly. Every transaction carries costs, visible costs in commissions and spreads, invisible costs in tax realization, and in the lost compounding on capital that is moved rather than allowed to sit. Activity in long-term investing is not neutral, it has a cost, and the investors who minimize activity, who buy quality businesses at reasonable prices, and then allow time to work without interference, tend to produce better results over full cycles than those who are constantly searching for the next improvement to the portfolio. This does not mean permanent passivity. It means having a high bar for action. Selling is appropriate when the business has fundamentally changed, when the competitive position that justified the original investment has been genuinely eroded, when management has made decisions that indicate the capital allocation discipline that was part of the thesis is no longer present, when the business model has been disrupted by external forces in a way that the original analysis didn't account for, and that there is no credible path to addressing. Selling is also appropriate when the price has risen so far above any reasonable estimate of intrinsic value that holding the position no longer reflects the margin of safety principle that justified buying it in the first place. What is not an appropriate reason to sell is short-term price weakness, quarterly earnings that missed estimates, general market volatility, the appearance of a more exciting opportunity, or the discomfort of holding a position that hasn't moved while other things are going up. These reasons feel compelling in the moment and are financially destructive over time. The behavior of the market during downturns is one of the most important things to have a predetermined framework for, because downturns are the moments when the most expensive mistakes are made. Markets decline. They have declined repeatedly throughout history. sometimes mildly and briefly, sometimes severely and for extended periods. Every decline that has ever occurred has been accompanied by a set of circumstances that made it feel different from previous declines, more serious, more structural, more likely to become a permanent impairment of value rather than a temporary disruption. Every decline has eventually ended, and the prices of quality businesses have eventually recovered and gone on to new highs. This historical pattern does not guarantee that any specific future decline will follow the same trajectory, but it provides a strong probabilistic basis for a framework that treats market declines as events to be navigated with discipline rather than panicked through with reactive selling. The investor who sells quality businesses during a significant market decline does two things simultaneously that compound the damage. They lock in the loss that existed on paper, converting it from a temporary impairment to a permanent one, and they remove the capital from the market at precisely the moment when prices are most favorable for future returns. Markets that have declined 30 or 40% offer dramatically better expected returns going forward than markets at their highs because the same businesses are now available at lower prices. The investor who holds through the decline and the investor who panics and sells are both experiencing the same paper loss at the bottom. Only one of them participates in the recovery. The framework for getting through declines without selling at the bottom is not bravery or unusual emotional fortitude. It is the prior work of owning businesses that are genuinely high quality at prices that reflected a margin of safety at the time of purchase, sized in positions that do not require selling at the worst moments to meet liquidity needs. If those three conditions are met before a decline begins, navigating the decline is painful but manageable. If they are not met, if the portfolio contains speculative positions purchased at full price, in concentrated sizes that create existential risk to the portfolio if they decline further, then the decline becomes a genuine crisis, and the decisions made during it will be driven by fear rather than framework. The practical application of all this begins before any stock is ever bought. It begins with the construction of a process, a defined set of criteria that a business must meet to enter the portfolio, a defined method for estimating intrinsic value and determining what price represents a sufficient margin of safety, a defined position sizing policy, and a defined set of conditions under which a position will be sold. Writing this process down before making any investment decisions serves a function that is easy to underestimate. It creates an objective reference point against which future decisions can be measured, independent of the emotional state in which those decisions are being made. When a market decline triggers the impulse to sell everything, the process document asks whether the businesses in the portfolio have fundamentally changed. When a hot sector generates enormous enthusiasm and the impulse is to chase performance, the process document asks whether the businesses in that sector meet the quality criteria and are available at a reasonable price. The process is not infallible, but it creates a barrier between emotional impulse and financial action that improves the quality of decisions at the margin, consistently over time, which is where investment performance is ultimately determined. The research process that feeds this framework requires developing a genuine understanding of the businesses being considered as investments, not a surface-level familiarity with the company's name and general industry. An actual understanding of how the business makes money, what its competitive advantages are, and why competitors haven't been able to erode them, how the business has performed across different economic environments, what the key risks are, and how management has historically responded to challenges. This depth of understanding is what allows an investor to maintain conviction during periods of price weakness, to hold a position when the market is selling it down because of short-term concerns that don't affect the long-term thesis, and what allows an investor to recognize when something has genuinely changed that requires a reassessment. Without that understanding, every piece of negative news about a holding becomes a potential reason to sell, and without the ability to evaluate that news in the context of the full business picture, the most likely response is to sell at exactly the wrong time. The information required for this level of understanding is largely public and free. Annual reports contain detailed descriptions of business operations, competitive position, risk factors, and financial performance across multiple years. Management commentary and earnings calls and investor presentations, evaluated critically rather than taken at face value, provides insight into how the people running the business think about capital allocation and long-term positioning. Industry publications and competitor filings add context. The work of reading and synthesizing this information is not effortless, but it is entirely accessible to any investor willing to do it. And the investor who has done this work on a business is in a fundamentally different position when market volatility creates price weakness than the investor who bought based on a recommendation, a short article, or the surface level fact that the company is well known and has been going up. One of the most valuable mental models for evaluating businesses and understanding what you are actually buying when you purchase a share of stock is the simple recognition that a share represents a fractional ownership of a real business, not a symbol that moves on a screen, not a token in a game, but a proportional claim on the earnings, assets, and future cash flows of an enterprise that employs real people, serves real customers, and operates in a real competitive environment. When this is genuinely internalized, when the question, "What price should I pay for this share?" is replaced by, "What price should I pay for a fractional ownership of this business?" the entire analytical framework shifts in a productive direction. The question becomes not what other market participants are likely to do with the price in the next 6 months, but what this business is likely to generate for its owners over the next decade. And that question is answerable with analysis, while the first question is answerable only with speculation. The pattern of behavior that consistently destroys returns in the stock market is almost perfectly described by the inverse of everything above: buying businesses without understanding what they do or how they make money, paying prices that already reflect optimistic assumptions with no margin of safety, concentrating in a small number of positions without regard for the consequences of being wrong on any one of them, holding only when prices are rising and selling when they fall, which is functionally equivalent to buying high and selling low. Measuring investment performance over quarters instead of years, which produces a distorted picture that confuses short-term price volatility with actual investment outcomes. Allowing financial media and market commentary to drive decisions that should be driven by the original investment thesis. Abandoning a strategy during its inevitable difficult periods and adopting a new one, then abandoning that one in turn, never staying with any approach long enough to allow its edge to accumulate. Each of these behaviors is individually damaging. Together, as a pattern, they produce the experience that most retail investors have of the stock market, the experience of participating in a period of enormous wealth creation in the overall economy and ending up with very little of it. Not because the market didn't offer the opportunity, but because the behavior made it impossible to capture. The strategy that works is the one that addresses the behavior directly, that builds a framework around the quality of the analytical process, the discipline of the entry criteria, the rigor of the risk management, and the patience of the holding period that systematically removes the behavioral gaps through which returns leak. It will not prevent every loss. Individual investments will fail despite rigorous analysis. Markets will decline and portfolios will decline with them. There will be periods where the approach produces results that look inferior to whatever is working in the current environment. And those periods are among the most psychologically difficult, because the temptation to abandon a sound approach in favor of what is currently working is nearly constant and nearly impossible to fully resist without a clear, documented framework to return to. But through those periods, the approach that maintains quality, price discipline, risk management, and patience will accumulate results that the approaches chasing short-term performance will not. Not because it wins every time, because over time, the structure of it is oriented toward the right outcomes, and time in the market, with that structure, is the mechanism through which those outcomes are eventually realized. Never losing again is not available in any market. What is available to anyone willing to do the work and maintain the discipline is something more durable and more valuable, a framework for participating in the stock market that produces results over the long run that significantly exceed what the alternative of reactive, unstructured, emotionally driven participation produces. That framework doesn't require genius, doesn't require privileged access to information, doesn't require perfect timing or flawless execution. It requires understanding, patience, and the consistent application of a process that keeps the behavioral self aligned with the analytical self across the full range of market conditions that time will inevitably produce. That is the strategy. Not the one that works every time, but the one that works over time. And over time, that distinction matters less and less as the results accumulate.